Pfizer continues to be trading at its 52-week low, still offering a yield of 5.4%. But is this a company that is extremely undervalued that we need to be buying, where we see the share price double or triple over the next few years and that yield on cost grow to double digits? In today's episode, we'll look at the historical performance of the company. We'll jump into their income statement with their new results coming out. We're going to look at the top line revenue as well as the bottom line net income growth year on year. We also want to look at the health of the company, their balance sheet, their total cash and total debt to see whether or not they can continue to pay those dividends. And we also want to see how they've performed year to date and over the last 5 years versus some big name competitors in the industry like AstraZeneca and Roche Holding. We're also going to take a look and see whether institutions continue to buy this company. And as always, we will look at that dividend safety and some important financial metrics for Pfizer that you need to understand before investing. And as always, we will run them through with their updated numbers into our intrinsic value calculator to get to our acceptable buy price given our individual investor margin of safety. Now let's take a look at the company. We can see it has been hammered down 41% year to date, again right there at the 52-week lows, and investors who have been holding the company over the last 10 years would be essentially flat on their investment. Now, yes, it doesn't include those dividends reinvested, but that is a very poor return on any investment, and we can see it did hit its highs at the back end of 2021 near $60, so nearly double the price that it's currently sat at. So let's take a look at the company and see what we can find. Now, top line revenue, we love to see 3 to 7% growth year on year at a minimum. 40.8 billion reported in December 2018. December 2022, 100.3 billion. Now, there's a few things to note. We can see it did remain fairly flat from 2018 to 2020. And then that COVID year did boost a lot of its sales, doubling from 2020 to 21. With that continued increase from COVID to 800 billion, from 81 to 100. Now, what is interesting to see, we haven't got the December 23 annual results, but the trading 12 months is showing us that we are expecting it to drop significantly from 100 billion, still up from the pre-COVID results, but far off that increase that we did see from 21 to 22. And we will touch upon that when we look at the last 10 years percentage-wise too. Now, how does the bottom line compare? Well, 11 billion in 2018, 31 billion in 2022, so nearly 3 times growth on the bottom line. We do see some inconsistencies though with that drop effectively from 2018 to 2020. So we see the increase and then a drop, and then it picks up and another nice increase to 2022. But like the revenue, the trading 12 months now without that COVID increases that we saw over the last few years, it has dropped down that bottom line to what we expect to be in line with 2018. But again, we will analyze that when we have a look at the 2023 December results. So that is a lot of things to consider now for Pfizer already, whether or not you believe that with their organic growth that they are doing, as well as acquisitions of other smaller companies in the industry, whether they can continue to increase their top line like they have done during that COVID period. Now, in terms of their total cash and short-term investments versus total debt, they had around 18.9 billion in 2018. And again, we would expect this to increase as we see to 22.7 billion due to the COVID, which affected their top line in a very positive way. And we also see from their latest quarterly report, it is up around 44 billion. So they are holding a lot more cash, nearly, in fact, more than double over the last 5 years. Now, total debt, how does that compare numerically and directionally? Well, it's gone from 42 billion of an increase of nearly 50% to 64 billion. So yes, they are holding more cash than they did 5 years ago, but we also see they are now having around 50% increase to their total debt. Now, how do they compare to some of their competitors in the industry, in the pharmaceuticals like AstraZeneca and Bristol Myers, Merck & Co., a lot of these that we have reviewed on the channel? Remember, this is total return, so includes those dividends reinvested. Negative 38%, so they are the worst performing out of their peers purely on a year-to-date total return basis. And on the 5 years, like we like to look at when we have the additional data, we can see they are down negative 10% now. They are also the worst performing over the last 5 years. Now, remember one thing as well, very important, we never look at past performance as an indicator for the future, but it's always good to have as any part of analysis. Now, institutional ownership, we see straight away 68% and around 11 billion worth of shares sold by these institutions over the last 12 months. During the same period, 96 billion inflow. So institutions are buying hand over fist Pfizer stock, and we can see that huge buy in Q2 of 74 billion versus that 4 billion that was an outflow. Again, please do not copy what institutions do on any trade or any investment. Always do your own due diligence. Now, very quickly, their latest reports that came out not too long ago, we can see on their top line, they did come in slightly lower than expectations by around 200 million, a negative 1.47 surprise, but they did beat on the earnings per share by 50%. Now, yes, they did come in 50% beat, but it was expected to be negative, and it was negative, but just to a smaller degree. Now, when we compare Q3 of 23 versus Q3 of 2022, what we can see and what we got the idea of when we looked at the trailing 12 months, that top line down 40%, that bottom line down 128%, the diluted earnings per share down into negatives, net profit margin down, operating margin down. So it is something just to bear in mind with Pfizer. A lot of what they are doing is spending to acquire smaller companies, so it may take some time before we see this to come into fruition. But as always, there are always reasons why companies do drop in general, so it's just about understanding whether or not now is the perfect time to buy, which we'll touch upon during our analysis of the valuation model. So in terms of some dividend metrics, well, 75 score on the dividend safety, making it safe, 171 billion. It is a mega cap company. And when we take a look at some recessionary metrics, well, unfortunately, they did cut the dividend during the 07-09 recession. Negative 6%, so above the average growth of companies in the S&P 500, which was negative to a larger degree. But they did beat the S&P as well at negative 45% versus negative 55%. At the end of the day, negative return on any investment is poor, but the majority of companies during the recession did have a negative return. Now, an increase of 2.5% in December 2022, which means we are due an increase over the next few weeks. Above 4% is what I like to see and advocate to all of the viewers, whether that's your dividends, salary, or other income producing assets. The reason for this, the US inflation rate was 4% over the last 40 years. Anything less, you're taking a pay cut and losing your purchasing power. 5% over the last 5 years, 6% over the last 20 years. Not too bad if you do consider that you are locking in a 5.41% yield, and that is if the interest rates do come down. So as we mentioned, they have been increasing their dividends over the last 12 years, in fact. And if we pay particular attention to dividend yield theory, it does state that a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, bearing in mind we're not looking at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. And we can see this is one of the largest yields that has been offered over the last 5 years. Forward PE slightly higher than the 5-year average of 12.1. Now, sector PE slightly lower than the healthcare at 16.4, and as mentioned, whilst it is at the 52-week low, do bear in mind 52-week low is never a signal for undervaluation. Likewise, 52-week high is not a signal for overvaluation. I ignore the earnings payout. The reason for that, the earnings is susceptible to manipulation by management through accounting. Investors have their own reasons for choosing which one, so I will draw your attention to the free cash flow. Now, below 60% is what I personally prefer. The reason for this is I believe management will be able to offer those double-digit increases we love to see. In the last few years, obviously, COVID had a massive effect, so we did see an increase in their top line. We can see below 60% quite considerably, but over the next 12 months, we can see it edging more towards 60%, so it will go higher. But I would like to see at least an increase over the next few weeks of around 4 to 6% for Pfizer. Now, free cash flow per share, 238 in 2013, 464 in 2022. If we remove the 2 COVID years, we can see it has effectively remained flat. The point now with this company is what can they do with all of that cash, all of that revenue they have brought in from COVID, and how can they push this company to the next level? And we can see 2023 expected to be around $2 to $2.50. Now, sales growth, we did mention, we'll look at the last 10 years. We can see, again, if we exclude the incredible COVID years they had, it has remained relatively flat / negative. So again, something just to bear in mind, because when we look at that numerically, from 2013 specifically to 2020, it in actual fact had a decrease on their top line. Now with COVID, it has shot up very, very high, with the trailing 12 months as we sort of expected to come lower. So I would be interested in your thoughts in the comments below as we're going through the video as to whether or not you believe Pfizer will be able to increase their top line continually over the foreseeable future. Now, shares outstanding 6.9 billion, so they have been returning excess cash to investors' pockets by doing share buybacks, now sitting around 5.73 billion, which is always positive for an investor. On the margins, well, first we can jump to the ROIC. Again, it is one of my 7 golden dividend metrics, so I do pay particular attention to this. 10% or more, it means, in my opinion, management are able to effectively allocate their capital. And even if we do remove the last 2 years, it has been around that 10% on average, so that is fairly positive in my opinion. But one thing to note is it is expected to drop down, as we can see that trading 12 months. So it is just a questionable metric for Pfizer currently. On the margins, whilst it is very, very positive, it has been above the 12% on both the operating and above the 5% on the free cash flow. We can note that drop that is expected on the trailing 12 months significantly on both margins. So again, it is something that we will dissect when we get the December annual report to compare versus the prior years. Now, net debt to EBITDA, earnings before interest, tax, depreciation, and amortization, it is one of those factors that affects the dividend safety. Below 3, which signals the number of years it would take the company to pay off all of their debt net of cash on hand. With the cash inflow they had from COVID, we do see this drop significantly from 2019 and 2020. So it only take them 0.41 year to pay it all off, although it is expected to come up to around 1 in 2023, but is still significantly lower than this 3, and therefore we do see when we go to the top that dividend safety score of 75. Now that is essentially the valuation metrics that we have gone through, and now we'll run it through our valuation model. As always, if you enjoy the content, value is being provided, smash the like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. Starting off, we have Graham's valuation formula with the earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bond to give an intrinsic value of $33. Remember, the higher the yield, the lower the intrinsic value. And at $33, we can see there is about 10% upside to the current trading price within the 52-week range, showing some undervaluation in the market currently, but also bearing in mind we're not looking at any of these models in isolation, and we'll draw a conclusion towards the end of the episode. We then have the multiples valuation model, companies in a similar sector and size that we analysed on the 5-year essential total return: AstraZeneca, Sanofi, Bristol Myers, Amgen. Stock price, earnings per share, P multiple. We get the average, multiply that by the earnings per share of Pfizer to get an essential multiples valuation model of $35. And again, we can see that's around 15 to 20% upside to the current trading price, but within that 52-week range, again, another sign of undervaluation. We then move on to the DDM, dividend discount model, where we can see the yearly dividends for Pfizer. Growth rate on average around 3.8%. Personally, I've just gone for essentially just slightly lower than the average at 3.75%. As always, if you grab a copy of the model, you can play around with all of these numbers and estimates. So the DDM of $40, we can see some nice upside to the current trading price, and we can see it's still within that 52-week range, showing some signs of undervaluation. We then move on to the DCF model, the discounted cash flow model with our free cash flows year on year. Average growth rate at 12%. Now, analysts are estimating negative growth to Pfizer moving forwards, but again, you can always play around with this depending on what you believe. The discount rate, we then get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding to get a DCF price of $43.76. Again, some nice upside to the current trading price, but still within that 52-week range. So the intrinsic value, as always, is purely the average of these 4 models that we have just run through. And again, if you do enjoy the content, value is being provided. Do hit that like button. In fact, smash the like button right now. Click the subscribe and bell button so you are continually notified of these videos as they drop. So we get a current intrinsic value of $38, and we put in our margin of safety 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now that would mean a buy up to $34. If you were looking at a 20% margin of safety, it would be a buy up to $30.50, which is roughly the current trading price. So you could argue right now, if you were to lock in a price at around the current trading price, you would be getting a margin of safety of 20%. Now, Wall Street believes the price over the next 12 months to go slightly higher than our intrinsic value calculated, but they see around 30% upside. So currently, based on our estimates and judgments, you're locking in a 20% margin of safety, whilst Wall Street believe from this position onwards, you are looking at 30% upside. As always, let me know your thoughts in the comments below. Is Pfizer one that you've been adding to or one you've been looking to sell? Or even if you're on the sidelines, let me know your general thoughts of Pfizer. And don't forget to smash the like button if you've enjoyed the content. It does help push this content out to other investors. Do hit the subscribe and bell so you're continually notified of these videos as they drop. And finally, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, or if you just want to run through these numbers but with your own judgments, do click on that pinned comment. As always, have a great day, catch you on the next episode, and take care.